Before we begin, a quick and important disclaimer. The information provided in this video is for educational and informational purposes only and does not constitute financial, legal, or professional advice. I am not a licensed financial advisor or mortgage loan originator. The mortgage landscape is complex and changes frequently. Always consult with a qualified and licensed professional before making any financial decisions regarding a home loan. Your financial situation is unique, and the guidance of a professional is essential to ensure you choose the best path for your specific circumstances. You found it. The one. The house with the big backyard for the dog. The kitchen with the perfect island. In that school district you've been dreaming about. You can already picture where the Christmas tree will go. The feeling is electric. You're ready to make an offer, you're ready for the keys, you're ready to start your new life. And then you get the paperwork, and your heart sinks. Suddenly you're drowning in an alphabet soup of acronyms. FHA via USDA, ARM, DTI, LTV, PMI. It feels like a foreign language specifically designed to confuse you, to make you feel small, to make you second-guess the biggest financial decision of your life. You start to panic. What if you choose the wrong one? What if you sign on a dotted line that costs you tens of thousands of dollars over the next 30 years? That fear, right there, is exactly why millions of Americans overpay for their homes. But that is not going to be you. Not after watching this. Because over the next few minutes, we are going to pull back the curtain on the entire U.S. home loan industry. We're going to demystify the jargon, expose the hidden costs, and arm you with the knowledge you need to walk into any lender's office with unshakable confidence. This isn't just about understanding your options. It's about mastering them. It's about transforming you from a nervous first-time buyer into a savvy, informed consumer who can spot a bad deal from a mile away. The goal here is simple: to save you money, save you stress, and put you in the absolute best position to build wealth through your new home. First, you have to understand the fundamental dynamic at play. When you walk into a bank or talk to a mortgage broker, you are not just a customer. You are entering a negotiation. They have a goal and you have a goal, and they are not the same. Their goal is to sell you a loan product that makes them the most money with the least amount of risk. Your goal is to secure a loan that costs you the least amount of money over its lifetime. The gap between their goal and your goal is where people lose thousands. The only way to close that gap in your favor is with knowledge. So let's start building that knowledge right now by tackling the two heavyweights, the two loan types you will hear about more than any others: the conventional loan and the FHA loan. Let's start with the conventional loan. Think of this as the gold standard of mortgages. It's the loan that isn't backed or insured by a government agency. It's a straight-up agreement between you and a private lender, like a bank or a credit union, who then follows a set of rules laid out by Fannie Mae and Freddie Mac, two giants in the housing finance world. Now, for decades, a myth has surrounded conventional loans: the 20% down payment myth. You've heard it. You can't buy a house unless you have 20% to put down. This is one of the most persistent and damaging falsehoods in real estate. It has kept millions of renters on the sidelines, thinking they could never afford a home. The truth? You can get a conventional loan with as little as 3% down. Let me say that again. 3%. On a $300,000 house, that's $9,000, not the $60,000 the myth would have you believe. This is a game changer. So, who is the conventional loan for? It's typically for borrowers with a stronger financial profile. The magic number you'll hear is a 620 credit score. That's generally the minimum score you need to even get in the door for a conventional loan. However, the better your credit score, the better your interest rate will be. A borrower with a 760 credit score is going to get a significantly lower interest rate than someone with a 640 score, which could save you hundreds of dollars every single month. Now let's talk about that down payment. If you put down less than 20% on a conventional loan, you will have to pay something called PMI, which stands for Private Mortgage Insurance. This is crucial to understand. PMI does not protect you. It protects the lender. It's an insurance policy the bank forces you to pay for in case you stop making your payments. It's like the bank is saying, hey, you're a bit of a risk since you didn't put 20% down. So you need to pay for an insurance policy that pays us back if you default. This cost is rolled into your monthly mortgage payment and can range from $30 to over $100 per month for every $100,000 you borrow. But here's the beautiful thing about PMI on a conventional loan. It goes away. Once you've paid down your mortgage to the point where you have 20% equity in your home, you can call your lender and request to have the PMI removed. It automatically drops off once you reach 22% equity. This is a massive advantage. So, to recap, conventional loans, ideal for borrowers with good to excellent credit, can be obtained with as little as 3% down, but you'll pay PMI if you put down less than 20%. And that PMI eventually disappears. Okay, let's pivot to the other giant, the FHA loan. FHA stands for the Federal Housing Administration. This is a government-insured loan. The government is essentially co-signing for you, telling the lender, "Don't worry, if this borrower defaults, we've got your back." This government backing makes lenders much more willing to approve people they might otherwise see as too risky. And that's exactly who the FHA loan was designed for. First-time homebuyers or people who have had some credit hiccups in the past. The credit score requirements are far more lenient. While 620 is the floor for conventional, you can often get an FHA loan with a credit score as low as 580, and sometimes even lower depending on the lender. The down payment is also a huge draw. FHA loans allow you to put down as little as 3.5%. So on that same $300,000 house, that's a down payment of $10,500. It's incredibly accessible, and has been the key that has unlocked the door to homeownership for millions of American families. It sounds amazing, right? Lower credit score requirement, tiny down payment. But this is where you have to pay close attention. There is no free lunch. The FHA loan comes with a significant catch, and it's all about mortgage insurance. Unlike the single PMI on a conventional loan, FHA loans have a double whammy of mortgage insurance. First, there's an upfront mortgage insurance premium, or UFMIP. This is a one-time fee, currently 1.75% of your total loan amount, that gets added to your mortgage balance right at the beginning. On a $300,000 loan, that's an extra $5,250 you're now paying interest on for the next 30 years. But it doesn't stop there. You also have to pay an annual mortgage insurance premium, which is paid monthly. This is the FHA's version of PMI. And here is the single most important difference you need to know. If you put down less than 10% on an FHA loan, that monthly mortgage insurance payment is there for the entire life of the loan. It never goes away. You could be making payments for 29 years, have 90% equity in your home, and you will still be paying that mortgage insurance every single month. The only way to get rid of it is to refinance into a different type of loan, like a conventional loan, once you have enough equity. So the FHA loan is a powerful tool. It's fantastic for getting your foot in the door of homeownership if you have less than perfect credit or a smaller down payment. But it's generally more expensive over the long run because of that permanent mortgage insurance. It's often best viewed as a stepping stone loan, a way to buy a home now and build equity with a plan to refinance out of it in a few years. So there you have it. The two titans of the mortgage world. Conventional, the lean, efficient choice for those with strong credit, where the mortgage insurance is only temporary. And FHA, the accessible, flexible option that opens doors for many, but at the cost of more expensive and permanent mortgage insurance. Understanding the fundamental trade-offs between just these two loans puts you ahead of half the homebuyers out there. But what if you're a veteran or an active duty service member? Or what if you want to buy a home out in the country, and you've heard whispers of a loan that requires absolutely zero money down? That's where two other powerhouse loans enter the picture, and one of them is, without a doubt, the single greatest mortgage product ever created in the United States. And that's exactly what we're breaking down next. Let's start with the undisputed champion, the heavyweight title holder of home loans, the VA loan. Backed by the U.S. Department of Veterans Affairs, this loan isn't just a financial product, it's a thank you. It's a benefit earned through service to the country, and it is, without a shred of doubt, the most powerful home buying tool available to any American. So, who gets to wield this power? The VA loan is specifically for veterans, active duty service members, and in some cases, surviving spouses. If you've served a minimum amount of time in the Army, Navy, Air Force, Marines, Coast Guard, or even the National Guard or Reserves, you have likely earned this benefit. It's not a one-time thing either. You can use your VA loan benefit over and over again. Now, why do I call it the greatest mortgage product ever created? Let's build the case. First, and most famously, is the 0% down payment. Not 3.5% like an FHA loan. Not 3 or 5% like some conventional loans. Zero. Zilch. Nada. On a $400,000 home, that's the difference between needing to save up $14,000 for an FHA loan and needing to save up exactly nothing for your down payment with a VA loan. This single feature has allowed millions of service members to become homeowners years, or even decades, before they otherwise could have. It completely removes the single biggest barrier to entry for buying a home, But that's just the opening act. The main event, the feature that truly catapults the VA loan into legendary status, is this: no private mortgage insurance. PMI. Remember that pesky extra fee we talked about with FHA loans? The one that protects the lender, not you, and can add hundreds of dollars to your monthly payment? With a VA loan, it's gone. It doesn't exist. Let's put that into perspective. On that same $400,000 home with a conventional loan and a small down payment, PMI could easily cost you $200 a month. That's $2,400 a year. Over 5 years, that's $12,000 that vanishes into thin air, with zero benefit to you. With a VA loan, that $12,000 stays right where it belongs, in your pocket. This isn't just a small perk. It is a colossal long-term financial advantage that dramatically increases your buying power and lowers your monthly cost of living. But wait, there's more. Because the loan is partially guaranteed by the government, lenders view VA loans as very low risk. What does that mean for you? It means you get some of the most competitive, lowest interest rates on the market. A lower interest rate over 30 years can save you tens of thousands of dollars. The VA also limits the closing costs that lenders are allowed to charge the veteran, protecting you from junk fees. And of course, there's never a penalty for paying the loan off early. And here's a secret weapon most people don't even know about: VA loans are assumable. This is a huge deal. It means that if you sell your home down the road, the buyer, if they are also VA eligible, can literally take over your existing loan at your original interest rate. Imagine you got a VA loan with a 3% interest rate. A few years later, market rates are at 7%. Being able to offer a buyer a 3% interest rate in a 7% world makes your home infinitely more attractive and valuable. It's an incredible feature. So zero down, no PMI, low interest rates, and it's assumable. Sounds too good to be true. So what's the catch? Well, there are a couple of things to be aware of. The biggest one is the VA funding fee. To help keep the program running without costing taxpayers, most veterans will pay a one-time funding fee. This fee is a percentage of the loan amount and it varies. For first-time users putting zero down, it's typically 2.3%. On that $400,000 loan, that's a $9,200 fee. Now, before you panic, you almost never pay this out of pocket. In nearly all cases, the funding fee is simply rolled into your total loan balance. So while it does increase your loan amount slightly, it doesn't prevent you from getting into the home with no money out of pocket. And here's a critical exception. Veterans who receive compensation for a service-connected disability are completely exempt from the funding fee. They pay nothing. The other catch is simply the eligibility. You have to have served. It's an earned benefit, not a public program. The VA also has what are called minimum property requirements, or MPRs. The VA appraiser will make sure the home is safe, sound, and sanitary. This isn't really a downside. It's a protection for the veteran. But it does mean you can't use a VA loan to buy a total fixer-upper that has major structural or safety issues. So that's the VA loan. A true powerhouse. But what if you haven't served in the military? Is the dream of a zero down payment home out of reach? For millions of Americans, the answer is a surprising and resounding no. Enter the underdog, the hidden gem of the mortgage world, the USDA loan. When people hear USDA, they think of steaks and farmers. But the U.S. Department of Agriculture also has a mission to develop rural and suburban communities, and their primary tool for doing that is the USDA Rural Development Home Loan. And let me be clear, you do not have to be a farmer to get one. Not even close. The USDA loan is designed for low to moderate income families who want to buy a home in an eligible area. And just like the VA loan, its flagship feature is 100% financing. Zero down payment required. So what are the requirements? There are two big ones. First, geography. The property you're buying must be located in a USDA-eligible area. And this is where the biggest misconception lies. The USDA's definition of rural is incredibly broad. It includes small towns, suburbs, and vast swaths of land on the outskirts of major metropolitan areas. You would be absolutely shocked to see the maps. 97% of the landmass in the United States is in a USDA-eligible area. You can go right to the USDA's website, type in an address, and instantly see if it qualifies. For many people who think they live in the suburbs, they'll be surprised to find their entire town is eligible. The second big requirement is income. Because this program is meant to help low to moderate income families, there are income limits. Your total household income cannot exceed the limit for that county. The limits are actually quite generous and vary based on the cost of living and your family size. Again, this is something a good lender can check for you in about 5 minutes. If you meet the income and location requirements, you get access to an incredible loan. You get the 0 down payment, and you also get very competitive 30-year fixed interest rates because the loan is guaranteed by the government, just like FHA and VA loans. Now, how does it stack up against the VA loan? It's a fantastic option, but it does have one key difference. Unlike the VA loan, the USDA loan does have a form of mortgage insurance. They call it a guarantee fee. There's a small upfront fee that, just like the VA funding fee, gets rolled into the loan amount. And there's a small annual fee that is paid monthly as part of your mortgage payment. This monthly fee is significantly lower than the one on an FHA loan, but it's still there. This is what makes the VA loan, with its complete absence of monthly mortgage insurance, the superior product. But let's not downplay the power of the USDA loan. For a qualified buyer who wants to live in a small town or a growing suburb, it is an unbelievable opportunity to buy a home with absolutely no money down. It's the closest a civilian can get to the power of a VA loan. So we have these incredible government-backed programs, FHA, which gets you in the door with a low down payment, and the 2-0 down titans, the VA loan for our service members, and the USDA loan for families in suburban and rural communities. They are purpose-built to make homeownership accessible. But what about the loan that over 60% of all homebuyers in America actually use? The one you hear about on the news, the standard bearer of the industry, the conventional loan. You might think it's the boring vanilla option, but it is hiding a secret weapon. A feature that, for the right buyer, can save you tens of thousands of dollars over the life of your loan. A powerful advantage that these other government loans just don't have. And that's exactly where we're going next. That secret weapon is called assumability, and it's one of the most overlooked, yet potentially most powerful features in the entire American mortgage landscape. Most people hear the term and their eyes glaze over. Sounds like boring financial jargon, but I want you to think of it like a time machine. An FHA loan with a low interest rate isn't just a loan. It's a financial time capsule. It allows a future buyer of your home to travel back in time and inherit the incredible interest rate you locked in years earlier. Let me make this real. Let's imagine a homeowner named Sarah. Back in 2021, when interest rates were hitting historic lows, Sarah bought her first home for $400,000. She used an FHA loan because she only had enough for a small down payment. She locked in a 30-year fixed interest rate of 3%. Her monthly principal and interest payment was about $1,628. For 3 years, she lives in the house, pays her mortgage, and builds a life. Now let's fast forward to today. Sarah gets a job offer in another state. She has to sell her house. In the meantime, the market has been kind, and her home is now worth $450,000. Now let's meet our buyer, Mike. Mike loves Sarah's house. It's perfect for his family. He's been saving for years and is ready to buy. But Mike is shopping for a loan today, not back in 2021. The interest rate he's being quoted is 7%. If Mike were to get a brand new loan for that same house, let's say he's financing the same amount Sarah originally did, around $386,000. At a 7% interest rate, his monthly principal and interest payment would be roughly $2,568. Take a second to absorb that. Sarah's payment, $1,628. Mike's payment for the functionally same amount of debt, $2,568. That's a $940 a month difference. That's over $11,000 a year. Over the 30-year life of the loan, Mike will pay over $338,000 more in interest than Sarah would have. It's the exact same house, but it exists in two completely different financial realities, separated only by time and the interest rate. This is the predicament facing millions of buyers in America right now. They're locked out by the math. But Sarah has the secret weapon. Her FHA loan is assumable. This means Mike doesn't have to go to a bank and get a new 7% loan. Instead, he can go through a process with Sarah's lender to legally take over, or assume, her existing mortgage. He inherits her remaining loan balance, her remaining term, and most importantly, he inherits her 3% interest rate. Suddenly, Mike's reality changes. His monthly principal and interest payment isn't $2,568. It's $1,628. He is instantly saving $940 every single month. That's money for groceries, for car payments, for saving for college, for living his life. By assuming Sarah's loan, Mike will save over $338,000 in interest payments over the next 27 years. This is not a gimmick. It's not a loophole. It is a built-in feature of FHA and other government-backed loans like VA and USDA. It turns a house from just a physical structure into a financial vehicle. When Sarah sells her house, she's not just selling wood and drywall. She's selling a 3% interest rate in a 7% world. That makes her house exponentially more attractive than the identical house next door that's being sold by someone with a conventional loan. Mike can afford Sarah's house. He probably can't afford the one next door. Sarah can likely sell her home faster and for a better price because of this feature. It's a win for her, and a life-changing win for Mike. Now I know what you're thinking. This sounds way too good to be true. There has to be a catch. And you're right, there is. It's a big one, and it's the reason you don't see this happening every single day. The catch is the equity. Remember, Sarah bought the house for $400,000, but it's now worth $450,000, and she's been paying down her mortgage for 3 years. Let's say her remaining loan balance is now $375,000. The agreed-upon sales price is $450,000. When Mike assumes the loan, he's only taking on that $375,000 of debt. But he has to pay Sarah for the value she's built up. The difference between the sales price and the loan balance is $75,000. Mike has to come up with that $75,000 to give to Sarah at closing. And that's the barrier. Most buyers, especially first-time buyers who are attracted to FHA loans in the first place, do not have an extra $75,000 sitting around in cash. This is where the dream usually dies. But for the savvy buyer and a knowledgeable lender, it doesn't have to. The solution is often a second mortgage. Mike could potentially assume the first FHA mortgage for $375,000 at that beautiful 3% rate, and then take out a smaller separate loan like a home equity line of credit or a fixed-rate second mortgage to cover the $75,000 equity payment to Sarah. Now that second loan will be at today's higher interest rate, let's say 9%. That sounds bad, right? But let's do the math. You have a huge loan at 3% and a tiny loan at 9%. When you combine them, your blended rate on the total amount borrowed is still drastically lower than if you got one giant loan at 7%. In this scenario, Mike's blended rate would be somewhere around 4%. He's still winning by a massive margin. He's still saving hundreds of dollars every month and hundreds of thousands over the life of the loan. This completely reframes the purpose of an FHA loan. It's not just a tool to help people with low down payments get into a home. It's a strategic decision that can pay massive dividends years down the road. Getting an FHA loan today, even in a higher rate environment, means you are creating one of the most powerful selling features imaginable if rates are still high when you go to sell. You're giving your future buyer a golden ticket. So, the FHA loan has this incredible superpower: the ability to pass a low interest rate through time, saving the next owner a fortune. It's a feature that conventional loans, the most common type of mortgage in the country, simply do not have. For this reason alone, the FHA loan seems like the obvious choice. But this incredible power comes at a price. A mandatory, and for most borrowers, a lifelong fee that gets tacked onto your mortgage payment every single month. It's the kryptonite to the FHA's superpower. It's called mortgage insurance premium, or MIP. And it's the single biggest drawback of the FHA program. It's an extra cost that can slowly and silently eat away at the financial advantage you think you have. And it's this hidden cost, this permanent financial passenger, that makes the conventional loan suddenly look a whole lot more attractive. Is the power of assumability worth the permanent chain of mortgage insurance? That's the critical battle we have to analyze next. Let's settle this debate right now. FHA versus conventional. The flexible newcomer with a secret weapon versus the established champion with a cleaner track record. At the heart of this battle are two acronyms that sound almost identical but represent fundamentally different philosophies: MIP and PMI, mortgage insurance premium for FHA, and private mortgage insurance for conventional. Understanding the microscopic differences between these two is the key to saving tens of thousands of dollars over the life of your loan. Let's start with the FHA's version MIP. This isn't just one fee. It's a two-pronged attack on your wallet. First, there's the upfront mortgage insurance premium, or UFMIP. As of today, this is a hefty 1.75% of your total loan amount. So, on a $300,000 loan, that's an immediate $5,250 fee. Now, most people don't write a check for this. Instead, it gets rolled right back into your loan balance. Your $300,000 loan just became a $305,250 loan before you've even made your first payment. You're paying interest on an insurance premium for the next 30 years. But that's just the opening act. The main event is the annual MIP, which is paid in monthly installments. This percentage can vary, but a common rate is around 0.55% of the loan amount per year. On that same $300,000 loan, that's $1,650 a year, or an extra $137.50 tacked onto your mortgage payment every single month. And here is the single most important, most devastating detail about FHA mortgage insurance. If you put down less than 10%, which almost every FHA borrower does, that $137.50 per month payment is for the life of the loan. It never ever goes away. 30 years, 360 payments. That's a total of $49,500 in monthly MIP, on top of the $5,250 you rolled into the loan up front. You could pay your loan down to a single dollar, and you would still be paying that mortgage insurance. The only way to get rid of it is to sell the house or refinance into a different type of loan. This is the permanent financial passenger we talked about. It gets in the car on day one and never leaves. Now let's pivot to the conventional loans PMI. Private mortgage insurance works differently. It's required if you put down less than 20%, but unlike the FHA's one-size-fits-all approach, PMI is highly personalized. It's all about risk, and the biggest factor they look at is your credit score. This is where the game completely changes. Let's take that same $300,000 loan, but with a 5% down payment on a conventional loan. If you have an excellent credit score, say 760 or higher, your PMI rate could be incredibly low. We're talking maybe 0.3%. That's only $75 a month. Compare that to the FHA's $137.50. You're saving over $60 a month right out of the gate. But here's the knockout punch. Conventional PMI is temporary. By federal law, once your loan balance drops to 78% of the original home value, the lender must automatically terminate your PMI. It just vanishes. You can also proactively request its removal once you hit 80%, which can happen even faster if your home's value appreciates. So that's $75 a month? You might only pay it for 5, 6, or 7 years. Let's say 7 years. Your total cost for PMI would be $6,300. Compare that to the nearly $50,000 you'd pay over the life of the FHA loan. This isn't even a close fight. For a borrower with good credit, the conventional loan is an absolute financial grand slam. So why would anyone ever choose FHA? Because of the scenario we just described. FHA doesn't really care about your credit score as much. While a conventional lender might see a 640 credit score and charge an astronomically high PMI rate, say 1% or more, that's $250 a month, or they might just deny the loan altogether. FHA, on the other hand, will still give you that standard 0.55% MIP rate. In this case, FHA's $137.50 a month is a much better deal than the conventional loan's $250. This reveals the true purpose of each loan. FHA is an access program. It's designed to get people with lower credit scores and minimal savings into a home. It's a stepping stone. The classic strategy is to use an FHA loan to buy your first home, spend a couple of years building equity and improving your credit score, and then refinance into a conventional loan to ditch the lifetime MIP. You use FHA to open the door, and conventional to secure your long-term financial health. A conventional loan is an execution program. It rewards financial discipline. If you have a strong credit score, even with a low down payment, it offers you the cheapest, most efficient path to homeownership. It says, "We see you've managed your finances well, so we're going to remove the training wheels and give you a better deal." Now let's bring it all back to that FHA superpower, assumability. Is the chance of having an assumable loan in the future worth the guaranteed higher cost of lifetime mortgage insurance? Let's run the numbers for our good credit borrower. They're choosing FHA over conventional, so they're paying an extra $62.50 a month, $137.50 MIP minus $75 PMI, for this feature. Over 30 years, that's a guaranteed extra cost of $22,500. And that's before we even factor in that the PMI would have eventually disappeared anyway, making the FHA cost astronomically higher in the long run. You are literally paying thousands upon thousands of dollars for a lottery ticket. A ticket that says if interest rates are dramatically higher when you sell, and if you can find a buyer who can qualify to assume your loan, you might have an easier time selling your home. For the vast majority of people, especially those with good credit, it's a terrible bet. The mathematical certainty of the conventional loan savings will almost always outweigh the speculative fantasy of the FHA's assumability. So the verdict seems clear. If your credit is shaky, FHA is your champion, your entry ticket to the game. If your credit is strong, conventional is the undisputed king, saving you a fortune. It seems like we have our two main contenders, and we know exactly when to use them. But what if I told you there were two other loan types? Two government-backed loans that operate in the shadows for most people. But for those who qualify, they are the most powerful home buying tools in the entire country. They look at the 3.5% down payment of an FHA loan and the 3% down payment of a conventional loan and they laugh. Because their minimum down payment is zero. Nothing. Not a single dollar. And they look at the entire debate we just had, the soul-crushing, decades-long FHA MIP versus the temporary credit-based conventional PMI, and they sidestep it completely. Because for the most part, they have no monthly mortgage insurance. Zero down and no monthly MI. Sounds impossible. It sounds like a cheat code for buying a house. And for millions of Americans, it is. These are the VA loan and the USDA loan, and understanding how they pull off this financial magic is what we need to break down next. Let's start with the VA loan. This isn't just another mortgage product. It's a promise. A thank you codified into the American financial system. In 1944, as millions of GIs were set to return from World War II, the nation asked a fundamental question. How do we repay a debt that can never truly be repaid? Part of the answer was the Servicemen's Readjustment Act, forever known as the GI Bill. And buried within that landmark legislation was the VA Home Loan Program. Its mission was simple yet revolutionary: to give those who served our country a tangible foothold in the American dream they fought to protect: a home. So, how does it achieve the impossible? Zero down payment and no monthly mortgage insurance? The magic lies in one word: guarantee. See, a common misconception is that the Department of Veterans Affairs is lending the money itself. They're not. You still go to a private lender, a bank, a credit union, a mortgage company, just like with a conventional or FHA loan. But here's the game changer. The VA provides that lender with a guarantee. They essentially co-sign the loan. The VA tells the bank, listen, lend this eligible veteran the money to buy a home. If for some tragic reason they can't make the payments and the loan goes into foreclosure, we, the US government, will cover a portion of your losses. Suddenly, the bank's risk plummets. That massive 20% down payment they usually demand as a safety net? It's no longer necessary. The VA's guarantee is the safety net. It's the ultimate security blanket for the lender. And because the lender's risk is so dramatically reduced, they are willing and able to lend 100% of the home's value. That's how you get a zero down payment. Now, what about that pesky monthly mortgage insurance? Well, think back to why MI exists. It's an insurance policy that you, the borrower, pay for to protect the lender in case you default. But with the VA loan, the lender is already protected by the VA's guarantee. Having both would be like wearing a belt and suspenders to hold up the same pair of pants. It's redundant. The VA guarantee replaces the need for MI entirely. So it's gone. Not just for a little while. Forever. That's hundreds of dollars a month that stays in the veteran's pocket. Every single month. For the life of the loan. Now you're probably thinking, okay, this sounds too good to be true. There has to be a catch. And there is, but it's a reasonable one. It's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running for future generations of service members, reducing the cost to taxpayers. The exact percentage varies based on your service, your down payment amount, if you choose to make one, and whether it's your first time using the benefit. For a first-time user with zero down payment, it's typically a little over 2% of the loan amount. But here's the key. You don't usually have to pay this out of pocket. In most cases, the VA funding fee can be rolled right into the total loan amount. So while it does slightly increase your loan balance and monthly payment, it doesn't create a huge upfront cash hurdle. And this is incredibly important. Some veterans are completely exempt from this fee. Most notably, veterans receiving VA disability compensation and eligible surviving spouses do not have to pay the funding fee at all, making the deal even better. Eligibility is, of course, tied to military service. It's available to active duty members, veterans who met the minimum service requirements, and in some cases, surviving spouses. You'll need to get a certificate of eligibility, or COE, from the VA to prove to the lender that you've earned this benefit. But the bottom line is this. For those who qualify, the VA loan is, without a doubt, one of the most powerful mortgage options on the planet. But what if you didn't serve in the military? Is there another path to a zero down payment loan? For millions of Americans, the answer is yes. But it's not about who you are. It's about where you want to live. This brings us to the second cheat code loan, the USDA loan. When you hear USDA, you probably think of steaks or farming. And you're not wrong. It stands for the United States Department of Agriculture. But one of their core missions is to promote prosperity in rural communities. They want to encourage people to live, work, and build lives outside of the major metropolitan hubs. To do that, they created a home loan program with a goal that sounds very familiar: make homeownership more accessible. And they use the exact same playbook as the VA. The USDA doesn't lend you the money directly. You go to a private lender. But the USDA provides a guarantee on that loan, telling the bank, "We've got your back." This eliminates the lender's risk, and just like the VA loan, it eliminates the need for a down payment. Zero down. But the USDA program has its own unique set of rules. First, let's talk about mortgage insurance. Unlike the VA loan, which has none, the USDA loan does have a form of it. They call it a guarantee fee. It's broken into two parts. There's an upfront fee, which, like the VA funding fee, can almost always be rolled into the loan amount. And there's an annual fee, which is paid monthly as part of your mortgage payment. But, and this is a critical point, the percentage for this annual fee is significantly lower than the mortgage insurance premium on an FHA loan, and often cheaper than the PMI on a conventional loan. So while it's not zero like a VA loan, it's still a fantastic deal. The real catches for a USDA loan, the things that make it specific, are two giant requirements: location and income. First, location. The property you buy must be in a designated rural area. And this is where most people get it wrong. Your mind immediately pictures a farmhouse in the middle of a cornfield miles from civilization. That's not what the USDA means. Their definition of rural is incredibly broad. It includes small towns, suburbs, and vast swaths of the country that you would never think of as rural. Many towns with populations up to 35,000 people qualify. You might be shocked to find that the suburb you're currently renting in, or the town just outside the city you love, is entirely eligible for a USDA loan. The USDA has an online eligibility map where you can literally type in an address and it will tell you instantly if it qualifies. The truth is, 97% of the landmass in the United States is in a USDA-eligible area. The second requirement is income. This program is designed to help low to moderate income families. So your total household income cannot exceed the limit for that specific county. These limits are surprisingly generous and vary wildly across the country based on the local cost of living. The idea is to ensure the program is serving the people it was designed for, not wealthy buyers looking for a zero-down vacation home. So let's put it all together. The VA loan and the USDA loan are two sides of the same coin. They are mission-driven mortgages. The VA loan serves those who have served the nation. The USDA loan serves those who choose to live in and build up the nation's rural and suburban communities. Both use the power of a government guarantee to obliterate the single biggest obstacle to homeownership: the down payment. They are proof that buying a home with little to no money out of your own pocket isn't a fantasy. It is a reality for millions. We've now covered the four major loan types: conventional, FHA, VA, and USDA. You understand the down payments, the mortgage insurance, the core philosophies behind each one. You're miles ahead of most aspiring homebuyers. But choosing a loan type is only half the battle. The other half is choosing the loan structure. Is it better to pay off your house in 30 years or 15? What does fixed rate actually mean? And why should you be incredibly wary of its cousin, the adjustable rate mortgage, or ARM? Getting this part wrong can cost you tens, even hundreds of thousands of dollars over time. And navigating that choice is exactly what we need to tackle next. Let's picture two families, the Millers and the Jacksons. They live on the same street in identical houses, purchased at the same time for the exact same price: $400,000. Both families put down 20%, so they both needed a loan for $320,000. But they made one seemingly small decision that would radically alter their financial futures. The Millers chose a 30-year fixed-rate mortgage at 5%. The Jacksons, tempted by a lower initial rate, chose a 5-to-1 adjustable rate mortgage, or ARM, with a starting teaser rate of just 3%. For the first 5 years, the Jacksons felt like geniuses. Their monthly principal and interest payment was just over $1,350. The Millers, with their 5% fixed rate, were paying over $1,700. Every single month, the Jacksons had nearly $400 extra in their pocket. They'd see the Millers at the neighborhood barbecue and think, "Poor guys, they're overpaying. They didn't get the deal we did." That extra $400 a month felt real. It was a nicer family vacation, extra money for the kids' college funds, a new set of patio furniture. They were living a slightly better life, all because of that one smarter loan choice. They were winning, but that loan had a name for a reason. It was a 5-to-1 arm. The 5 meant the rate was fixed for the first 5 years. The 1 meant that after those 5 years, the rate would adjust every single year based on the prevailing market interest rates. And as their 5-year anniversary in the house approached, something started to happen in the wider economy. Inflation ticked up. The Federal Reserve began raising interest rates to cool things down. It started slowly, then it became more aggressive. The news was filled with talk of rate hikes. The Millers saw the same news. They'd talk about it over dinner, maybe feel a little bit of concern for the economy as a whole, but their personal situation was unchanged. Their mortgage payment was still $1,718.89. It was the same yesterday, it was the same today, and they knew with absolute certainty it would be the same next month and the month after that for the next 25 years. It was a constant, a rock in the middle of a raging economic river. For the Jacksons, that river was about to flood their home. They got a letter from their lender. It was filled with financial jargon, but the message was brutally simple. Their introductory 3% rate was expiring. Based on the current index, their new rate was jumping to 6%. Their monthly payment, which had been their pride and joy at $1,350, was about to become nearly $1,900. In a single month, their payment shot up by over $500. It was more than the extra money they'd been saving. It was a gut punch. The family vacation was canceled. The college fund contributions were paused. The budget became incredibly tight. And the nightmare wasn't over. Remember, it was a 5-to-1 arm. The rate adjusted every 1 year. The next year, rates had gone up again. Another letter arrived. Their new rate was now 7.5%. Their payment ballooned to over $2,200. In just 2 years, their monthly housing cost had increased by nearly $900. They were now paying $500 more than the Millers, the very people they once pitied. The Jacksons were trapped. Their income hadn't gone up by $1,000 a month. They started having hushed, panicked conversations after the kids were in bed. Can we afford this? Should we sell? But everyone was in the same boat. With rates so high, fewer people were buying, and home prices in their neighborhood had started to soften. They were facing the terrifying prospect of having to sell their home for less than they owed, all because they'd been tempted by that low initial rate. This story, which has played out in countless American households, is the single most important lesson in home financing. The choice between a fixed-rate mortgage and an adjustable-rate mortgage isn't a financial preference. For most people, it's a fundamental choice between stability and speculation. Let's break down exactly what these are. A fixed-rate mortgage is the soul of simplicity. The interest rate you lock in on day one is the interest rate you will have for the entire life of the loan, whether that's 15 years, 20 years, or the most common 30 years. If you get a 30-year fixed rate at 6%, your principal and interest payment will be the exact same on your first payment as it will be on your 360th payment, 3 decades from now. Your property taxes and homeowner's insurance can change, of course, but the core of your loan is immovable. It's predictable. It's boring. And in the world of personal finance, especially with your largest asset, boring is beautiful. It allows you to budget for the long term, to build a life without the constant fear of a payment shock hanging over your head. Now let's dissect the arm. The adjustable rate mortgage is a far more complex beast. It lures you in with that low teaser rate, which is fixed for an initial period, like the Jacksons' 5 years. After that, the rate adjusts periodically, usually every year, based on a specific financial index plus a margin. So your rate becomes the index rate plus, say, a 2.5% margin. If the index is at 4%, your rate is 6.5%. If the index shoots up to 6%, your rate becomes 8.5%. You are essentially tethered to the volatility of the global economy. To prevent absolute catastrophe, ARMs have caps. There's a periodic cap, which limits how much the rate can increase in any single adjustment period, often around 2%. And there's a lifetime cap, which limits how high the rate can go over the entire life of the loan, often 5% or 6% above your initial rate. The Jacksons' 3% loan might have a lifetime cap of 8%, so they knew their rate could never exceed 8%. But a jump from 3% to 8% is life-altering. Can literally double your monthly payment. These caps are not a safety net. They are the absolute ceiling of the disaster you could face. They define the dimensions of your worst-case scenario. So why would anyone ever choose an ARM? There are a few very specific, and I must stress, risky scenarios where it might be considered. First, if you know with near absolute certainty that you will sell the home before the first rate adjustment. For example, a medical resident who knows they are moving for a fellowship in exactly 3 years might consider a 3-to-1 ARM to save money in the short term. But life happens. Plans change. That certainty can evaporate, leaving you holding the bag. Second, a very high-income earner who can easily afford the absolute worst-case payment might use an ARM as a strategic tool, betting that rates will stay low and enjoying the savings. They are playing a numbers game and they have the cash flow to absorb a bad bet. This does not describe the average American homebuyer. Finally, in a very high interest rate environment, some might take an ARM hoping rates will fall, allowing their payment to decrease or allowing them to refinance into a lower fixed rate later. This is pure speculation. You are betting on your ability to predict the future of the economy. It's a gamble, plain and simple. For the overwhelming majority of people buying a primary residence, the place they will raise their family and build their life, the 30-year fixed-rate mortgage is the undisputed champion. It is the bedrock of American homeownership for a reason. It insulates your family's biggest expense from the chaos of the financial markets. It provides peace of mind, which is a value you cannot calculate on a spreadsheet. The allure of that low initial ARM payment is a siren song that has led countless families onto the rocks. The question you have to ask yourself isn't, how much can I save if rates stay low? The real question is, can I and my family financially survive if rates go to the moon? Because the difference between those two questions is the difference between building a stable future and gambling with the roof over your head. Now that we've established the vital importance of rate stability, we need to look at the different types of loans that come with these rate structures. We're talking about the big players, conventional FHA, VA, and USDA loans. Each has its own unique set of rules, down payment requirements, and credit score expectations, and one of them is almost certainly the path you will take. Knowing which door to knock on first can save you thousands of dollars and months of frustration. So let's knock on the first and most well-known door, the conventional loan. Think of this as the gold standard of mortgages. It's the loan you hear about most often because it's not backed or insured by a government agency. It's a direct agreement between you and a private lender, like a bank or a credit union. Because there's no government safety net, the lenders are taking on all the risk themselves. And what do they demand in return for taking that risk? A strong borrower. This is why conventional loans typically have stricter requirements. First, your credit score. While you might see minimums advertised as low as 620, the reality is that the better your score, the better your interest rate will be. A 740 score or higher is the sweet spot that unlocks the best possible terms. Second, your down payment. The myth is that you need 20% down for a conventional loan. That's not true. You can get a conventional loan with as little as 3% down, especially if you're a first-time homebuyer. But, and this is a huge but, if you put down less than 20%, you will have to pay something called private mortgage insurance or PMI. PMI is basically an insurance policy that protects the lender in case you stop making payments. It's an extra monthly fee, rolled right into your mortgage payment, that does absolutely nothing for you. It's pure protection for the bank. The good news? PMI on a conventional loan is not a life sentence. Once you reach 20% equity in your home, either by paying down the principal or through the home's value increasing, you can request to have that PMI removed. And by law, lenders must automatically terminate it once you reach 22% equity. This is a massive advantage. So, who is the conventional loan for? It's for the buyer with a solid credit history, a stable income, and a decent amount saved for a down payment. If you can put down 20%, you avoid PMI altogether, making it often the cheapest option in the long run. If you can't but you have great credit, it can still be a fantastic choice because you have a clear path to getting rid of that extra PMI payment down the road. But what if your credit isn't perfect? What if you haven't had 20 years to build a massive savings account? Don't worry. That brings us to the second door, the one that has made homeownership possible for millions of Americans. This is the FHA loan. FHA stands for the Federal Housing Administration, and their job is to help more people access housing. They don't actually lend you the money. Instead, they insure the loan for the bank. It's like the government is co-signing for you, telling the lender, hey, we've got your back. If this borrower defaults, we'll cover your losses. This government guarantee makes lenders feel a whole lot safer, so they relax their requirements significantly. With an FHA loan, the down payment requirement plummets to as low as 3.5%. The credit score requirements are also much more forgiving. You can often get approved with a score as low as 580. In some rare cases, even lower, though the terms might not be as favorable. This flexibility is why FHA loans are incredibly popular with first-time homebuyers and people who have had a few financial bumps in the road. So what's the catch? There's always a catch, right? With FHA loans, the catch is called mortgage insurance premium, or MIP. It sounds a lot like PMI, but it works very differently, and this is one of the most important things you need to understand. FHA's MIP has two parts. First, there's an upfront premium, which is a percentage of the loan amount that's typically rolled into your total mortgage balance. Second, there's an annual premium, which is paid monthly as part of your mortgage payment. Here is the critical difference. If you get an FHA loan today and put down less than 10%, you will pay that monthly mortgage insurance premium for the entire life of the loan. It never goes away. The only way to get rid of it is to refinance into a different type of loan, like a conventional loan, once you have enough equity. That is a massive long-term cost to consider. The FHA loan is a powerful tool, an amazing key that unlocks the door for many who would otherwise be shut out. But you have to go in knowing that its flexibility comes at the cost of that persistent mortgage insurance. Now let's move to a very different kind of door. This one isn't open to everyone. It's an exclusive earned benefit, reserved for a specific group of heroes. This is the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, the VA loan is, without a doubt, one of the most powerful mortgage options on the planet. This benefit is available to active duty service members, veterans, and in some cases, surviving spouses. The first step is to get your Certificate of Eligibility, or COE, to prove you qualify for this incredible program. And when I say incredible, I mean it. The VA loan has two superpowers that no other loan can match. Superpower number 1, zero down payment. That's not a typo. 100% financing. For most qualified borrowers, you can buy a home with absolutely no money down. In a world of soaring home prices, the ability to get into a house without having to save up tens of thousands of dollars is a complete game changer. Superpower number 2, no monthly mortgage insurance. No PMI, no MIP, nothing. Even with 0% down, the VA guarantee is so strong that lenders don't require that extra monthly insurance payment. The combination of no down payment and no PMI can save you thousands up front and hundreds of dollars every single month compared to other loan types. Now, it's not completely free. Most borrowers will pay a one-time VA funding fee. This fee varies depending on your service, your down payment amount, and whether it's your first time using the benefit. But this fee can also be rolled into the loan amount, and veterans receiving VA disability compensation are typically exempt from it entirely. For those who have served our country, the VA loan isn't just a mortgage program. It's a thank you. It is the single best path to homeownership for almost every veteran who qualifies. Okay, we've seen the gold standard, the people's champion, and the hero's reward. That leaves one last door, and it's one that many people walk right past because they don't think it applies to them. This is the USDA loan, and it might be the best kept secret in the mortgage world. When people hear USDA, U.S. Department of Agriculture, they think of farms, cows, and tractors. And they assume you have to be a farmer to get this loan. That is completely wrong. The USDA loan program isn't about what you do for a living. It's about where you want to live. It's a rural development loan designed to encourage growth in less populated areas of the country. And you would be shocked at what the USDA considers rural. Many small towns and suburban neighborhoods just outside of major metropolitan areas qualify. The USDA loan is a powerhouse that rivals the VA loan in its benefits. First, it also offers zero down payment, 100% financing for eligible buyers in eligible areas. Second, while it does have a form of mortgage insurance, it's typically much cheaper than the insurance on an FHA loan. So, what are the requirements? There are two main hurdles. First, the property itself must be located in a USDA-eligible area. The USDA has an easy-to-use online map where you can type in an address and see instantly if it qualifies. You might be surprised how many areas near you are eligible. The second hurdle is income limits. This program is designed for low to moderate income households, so your total household income can't be more than a certain amount, which varies by county and family size. But if your income is within the limit and you're looking to buy a home outside of a major city center, the USDA loan is an absolutely phenomenal option that you cannot afford to overlook. It's a zero-down path to homeownership that most people don't even know exists. Conventional, FHA, VA, and USDA. These are the four titans of the mortgage industry. Each one is a distinct path designed for a different type of homebuyer. One is built for financial strength, another for flexibility, one is an earned reward, and the last is a hidden gem for rural and suburban life. But knowing their features is only half the battle. How do you actually compare them side by side for your specific situation? How do you figure out which one will truly be the cheapest over the next 30 years? It's not just about the interest rate. In fact, a loan with a higher interest rate can sometimes cost you tens of thousands of dollars less. To understand why, you need to learn the secret language of lenders. You need to understand the difference between an interest rate and the APR, what points really are, and how to decode the mountain of closing costs that can blindside you at the finish line. And that is exactly where we're going next. Let's pull back the curtain on the three most misunderstood numbers in home buying: the interest rate, the annual percentage rate or APR, and discount points. Get these wrong and you could be paying tens of thousands of dollars more than you need to. First up, the interest rate. This is the number everyone talks about. It's the headline, the big flashy number lenders advertise. Think of it as the sticker price of your loan. It's the direct cost of borrowing money, expressed as a percentage. If your interest rate is 6%, you're paying the bank 6% per year on the outstanding loan balance. It's simple, it's straightforward, and it directly determines your monthly principal and interest payment. A lower interest rate means a lower monthly payment. Easy enough, right? But this is where so many people get tripped up. They shop for a loan based only on the interest rate. That's like buying a car based only on its sticker price without considering the dealer fees, the destination charges, the title and registration costs. The interest rate is only part of the story. The real story, the true cost of your loan, is told by the APR, the annual percentage rate. The APR takes the interest rate and then bundles in most of the other costs of getting the loan, things like lender origination fees, mortgage broker fees, and sometimes even points. It then spreads those costs out over the life of the loan and expresses it all as a single annual percentage. So your interest rate might be 6%, but after factoring in a $2,000 origination fee and other lender charges, your APR might be 6.25%. The APR is almost always higher than the interest rate because it includes those extra fees. It's designed by federal law to give you an apples-to-apples comparison between different loan offers. So which number is more important? They both are, but for different reasons. The interest rate determines your monthly payment, which is what you feel every single month in your bank account. The APR gives you a more complete picture of the total cost of the loan over its entire term. If you have two loan offers and Loan A has a 6% interest rate and a 6.3% APR, while Loan B has a 6.1% interest rate but a 6.2% APR, which one is better? It's Loan B. Even though the monthly payment will be slightly higher because of the higher interest rate, the total long-term cost of borrowing is actually lower, as indicated by the lower APR. This means Loan A is loaded with more upfront fees. If you plan to stay in the home for a long time, the loan with the lower APR is usually the better financial choice. If you think you might sell or refinance in just a few years, the math gets a little trickier, and the loan with the lower upfront fees might be more attractive, even with a slightly higher APR. The key is to look at both numbers and ask the lender, why is there a difference between my interest rate and my APR? What specific fees are included? Now let's talk about the third piece of this puzzle, points, or more specifically, discount points. This is where you can actively manipulate your interest rate, but it comes at a cost. A discount point is essentially prepaid interest. You pay a lump sum of cash to the lender at closing, and in exchange they give you a lower interest rate for the life of the loan. 1 point costs 1% of your total loan amount. So, on a $400,000 loan, 1 point would cost you $4,000 upfront. 2 points would cost you $8,000. In return for paying that 1 point, the lender might reduce your interest rate by, say, 0.25% from 6.25% down to 6%. Is it worth it? That depends entirely on your break-even point. You have to do the math. Let's stick with that $400,000 loan. Paying 1 point, $4,000, to lower your rate from 6.25% to 6.0% would save you about $60 per month on your payment. So, you take the upfront cost, $4,000, and divide it by your monthly savings, $60. The result is about $67. That's your break-even point in months. It will take you 67 months or about 5.5 years just to earn back the $4,000 you paid up front. If you are absolutely certain you will be in that house and not refinance for longer than 5.5 years, then paying for points could be a great investment. Every month after that break-even point, you're pocketing pure savings. But if you think there's a chance you might sell the house or refinance the loan in 3 or 4 years, you would have lost money. You would have paid $4,000 for a benefit you didn't stick around long enough to realize. Paying for points is a bet on your own future. Make sure you understand the odds before you place that bet. Okay, deep breath. We've covered rates, APR, and points. But those are just the lender-specific costs. We now have to face the mountain. Closing costs. This is the grab bag of fees from a dozen different third parties that are all required to get your deal to the finish line. On average, you can expect closing costs to be anywhere from 2% to 5% of your home's purchase price. On a $400,000 home, that could be anywhere from $8,000 to a staggering $20,000 on top of your down payment. This is where sticker shock truly sets in for most buyers. So let's demystify it. The lender is required by law to give you a document called a loan estimate within 3 days of your application. This document is your financial roadmap. It itemizes every single anticipated cost. You need to read it. Every line. You'll see things like an appraisal fee. This pays a licensed appraiser to determine the fair market value of the home, ensuring the bank isn't lending you more than the house is worth. A credit report fee. The cost for the lender to pull your credit history, title services, and lender's title insurance. This is a big one. A title company researches the property's history to make sure there are no outstanding liens, claims, or ownership disputes. The lender's title insurance protects the lender, not you, in case something was missed. You'll also likely want to buy a separate owner's title insurance policy to protect yourself. Escrow fees or closing fees. This pays the title or escrow company, a neutral third party, to handle all the funds and paperwork and ensure the closing happens correctly. Recording fees. The fee charged by your local county or city government to officially record the sale and your ownership in the public record. You might also see survey fees, inspection fees, attorney fees, and prepaid items. Prepaids aren't technically fees. They're your own expenses you have to pay up front at closing. This includes your first year of homeowner's insurance and several months of property taxes, which the lender puts into an escrow account to pay on your behalf. It's an overwhelming list. But here's the secret. Not all of these costs are set in stone. The fees on your loan estimate are separated into categories. Some, like the appraisal and credit report, you can shop around for. Others, like the government recording fees, are fixed. Your mission is to look at that loan estimate and ask your loan officer 2 powerful questions. Which of these fees can I shop for to find a better price? And can you explain every single one of your lender fees to me line by line? Understanding these numbers, the rate, the APR, the points, and the closing costs, is the difference between being in control of your home purchase and being taken for a ride. This knowledge gives you the power to compare offers intelligently and negotiate from a position of strength. You've decoded the numbers, you understand the costs. You're ready. But now comes the most critical and nerve-wracking phase. Underwriting. This is where the lender puts your entire financial life under a microscope. They'll scrutinize every bank statement, every credit card swipe, every job change. And one wrong move, one innocent mistake, can get your loan denied at the last second. We need to talk about the underwriting gauntlet and how to survive it. This is it. The final boss battle. You've found the house, you've got your pre-approval, you've signed the contract. You feel like you're on the home stretch, but in reality, you've just entered the most critical and nerve-wracking phase of the entire process. Underwriting. This is where a single person, the underwriter, holds the fate of your home loan in their hands. They are the gatekeeper, the final judge, the person whose job it is to protect the lender's massive investment by ensuring you are not a bad risk. And to do that, they will conduct what can only be described as a financial colonoscopy. Everything you've done financially for the past several months, and everything you do from this moment until you have the keys in your hand, will be examined with a level of scrutiny that would make a forensic accountant blush. So let's pull back the curtain. Who is this mysterious underwriter? They aren't your loan officer, the friendly face who has been guiding you. The underwriter is a neutral back-office analyst who has never met you and never will. They have no emotional connection to your dream of homeownership. Their entire professional existence is based on one thing: mitigating risk. They follow a strict set of guidelines laid out by the lender, by Fannie Mae, Freddie Mac, the FHA, or the VA. To them, you are not a person. You are a collection of numbers and documents. File. And their job is to find any inconsistency, any red flag, any reason at all that your file doesn't perfectly match the rulebook. One wrong move, and that file gets a big red denied stamp. To survive, you have to understand what they're looking for. Think of it as 4 pillars of underwriting scrutiny: income, assets, credit, and the property itself. Let's start with the first pillar: income and employment. You've already submitted your pay stubs and W-2s. The underwriter is going to verify every single one of them. They will call your employer, sometimes multiple times, right up until the day of closing, to confirm you are still employed and your salary hasn't changed. This is why the #1 rule of the underwriting gauntlet is: do not change jobs. I don't care if you're offered a promotion, a corner office, and a 50% raise at a new company. If you switch jobs between your application and closing, you are throwing a live grenade into the process. To an underwriter, a new job, even a better one, represents instability. You're in a probationary period. The income isn't seasoned. They have to re-verify everything from scratch, and some loan programs have strict rules about how long you must be in a new position before the income can be counted. The safest path is to become a statue. Stay put until the keys are in your hand. Then you can take the new job. The second pillar is assets. This is your cash. Your down payment, your closing costs, your reserves. The underwriter needs to see that this money is legitimately yours and that it has been in your account for a while, typically at least 60 days. This is where we see one of the most common and devastating mistakes: the large, unexplainable cash deposit. Let's say your wonderful grandmother gives you $10,000 in cash to help with the down payment. You gratefully deposit it into your checking account. To you, it's a gift. To an underwriter, it's a massive flashing red flag. Why? Because of federal anti-money laundering laws. They have no idea if that money came from your grandma or from an illegal enterprise. They see it as an undocumented loan that you might have to pay back, which would destroy your debt-to-income ratio. We call this mattress money, and it is poison to a mortgage application. If you are receiving a gift, it must be documented with a formal gift letter, and the funds must be sourced from the giver's account directly to yours, usually via wire or cashier's check, creating a paper trail that the underwriter can follow. The rule is simple: do not deposit any cash or any large, unusual sums of money into your bank accounts without first talking to your loan officer. Also, don't move money around between accounts. Pick 1 or 2 accounts for the transaction and leave them alone. Shuffling funds looks suspicious and creates a nightmare of a paper trail you'll have to explain. Now for the third and arguably most treacherous pillar: credit. Your credit score and history got you this far, but the underwriter is watching it in real time. This brings us to the cardinal sin of the mortgage process. Do not open any new lines of credit. I cannot say this forcefully enough. Do not buy a car. Do not finance new furniture for the house you don't even own yet. Do not apply for a new credit card to get a 10% discount at a department store. Do not co-sign for anyone for anything. Every time you apply for new credit, 2 terrible things happen. First, it triggers a hard inquiry on your credit report, which can drop your score. If your score drops below the minimum required for your loan program, you're done. Game over. Second, and more importantly, any new debt you take on increases your debt-to-income ratio. Lenders approve you based on a very specific DTI calculation. If you finance a $500 a month car payment, you could instantly push your DTI over the allowable limit, and your loan will be denied. It's like running a marathon and, in the final mile, deciding to pick up a 50-pound backpack. It's financial self-sabotage. Just freeze. Don't touch your credit. And it should go without saying, continue to pay every single one of your existing bills on time. A late payment during underwriting is a near-fatal blow. Finally, the fourth pillar, the one people forget: the property. The underwriter isn't just approving you. They're approving the house. They are lending hundreds of thousands of dollars, and the house is their collateral. They need to make sure it's worth the price you're paying. This is where the appraisal comes in. An independent appraiser will assess the home's value. If the appraisal comes in lower than the sales price, you have a problem. The lender will only loan based on the appraised value, meaning you'd have to come up with the difference in cash or renegotiate with the seller. The underwriter also reviews the title report to make sure there are no hidden liens or ownership claims on the property. They review the home insurance to ensure their collateral is protected. Any issue with these items can delay or even kill your deal, even if your personal finances are flawless. So how do you survive this? You have to change your mindset. For the 30 to 60 days you are in underwriting, you must become the most boring, predictable financial person on the planet. First, be a document ninja. When your loan officer or processor asks for a document, an updated bank statement, a letter of explanation for an old credit inquiry, get it to them immediately. The same day. Every day you delay is a day your closing is delayed. Second, communicate everything. Are you thinking of using your 401k for some of the down payment? Ask your loan officer first. Did you get a small raise at work? Tell your loan officer. They are your guide through this gauntlet. They know what the underwriter will question. Don't hide anything. They will find it. It's their job. You submit your last document. You wait. The silence is deafening. And then you get the email. Or the call. 3 of the most beautiful words in the English language. Clear to close. It means the underwriter has given their final approval. The beast has been slain. The gauntlet has been run. You feel a wave of relief so powerful it could knock you over. You've done it. You're going to be a homeowner. But being clear to close isn't the end of the road. It's the gate to the final step. The closing table. This is where you sign a stack of documents so thick it could stop a bullet. This is where you hand over the biggest check of your life. What are all those papers? What are closing costs, really? And how can you avoid the last-minute surprises and hidden fees that trip up so many buyers at the finish line? That's what we need to break down next. The final mile of the marathon. Closing day. This is it. The finish line. You've been pre-approved, you found the perfect house, your offer was accepted, and you've made it through underwriting. Now you're faced with a stack of documents and a final number called your cash to close. This is where the dream becomes reality, but it's also where confusion can set in. So let's demystify it piece by piece. First, let's talk about those infamous closing costs. In simple terms, closing costs are the fees you pay to everyone who helped make this transaction happen. Think of it like the final bill for a massive project. They typically range from 2% to 5% of your home's purchase price. But this can vary dramatically depending on your state and your specific loan. These costs fall into 3 main buckets. The first bucket is lender fees. This is what you pay your lender for the service of creating the loan. You'll see an origination fee, which is basically their administrative charge. You might see discount points, which, as we discussed, are fees you pay up front to lower your interest rate. You'll also see charges for pulling your credit report, an appraisal fee to confirm the home's value, and a flood certification fee to determine if the property is in a flood zone. These are the direct costs of getting the money. The second bucket is third-party fees. These are for services provided by companies other than your lender. The big one here is title insurance. This is crucial. It protects you and the lender from any future claims on the property's ownership. Maybe a long-lost heir shows up, or a contractor claims there's an unpaid lien on the house from the previous owner. Title insurance handles that mess. You'll typically pay for 2 policies. A lender's policy, which is required, and an owner's policy, which is for your own protection, and is one of the smartest purchases you can make in real estate. You'll also see fees for the escrow company or closing attorney who acts as a neutral third party to handle the money and paperwork, and potentially a survey fee if one was needed to verify property lines. The third, and often most confusing bucket, is prepaids and escrow funds. This isn't really a fee. It's you paying for some things in advance. You'll need to pay for your first full year of homeowners insurance premiums right at closing. You'll also need to prepay a few months' worth of property taxes. Why? Because the lender wants to make sure the house is insured and the taxes are paid from day one. They bundle these future payments into your mortgage, creating an escrow account. Each month, a portion of your mortgage payment goes into this account, and the lender uses that money to pay your insurance and tax bills for you when they're due. So at closing, you're just giving that escrow account a starting cushion. You'll also pay for any daily interest on the loan that accrues between your closing date and the end of the month. Now, how do you know what these costs are going to be before you're sitting at the closing table? This is where the single most important document in the final stage of your loan comes into play: the closing disclosure, or CD. By federal law, you must receive your closing disclosure at least 3 full business days before your scheduled closing. This is not a suggestion, it's your right. This 3-day review period is your golden opportunity. It's your final chance to review every single number and make sure it's correct. When you get that document, don't just glance at it. Stop what you're doing and grab the loan estimate, that document you got right at the beginning of the process. Your mission is to compare them line by line. Your interest rate should be the same. The loan type should be the same. The loan term should be the same. Most of the fees on the closing disclosure should be very close, if not identical, to what was quoted on your loan estimate. Some things like prepaid interest can change based on the day of the month you close, and that's normal. But if the lender's origination fee suddenly doubled, or there's a new mysterious processing fee you've never seen before, you need to raise a red flag. Scroll down to the bottom of the CD and find the most important number of all: cash to close. This is the exact amount of money you need to bring to the closing table. This number is your down payment plus all those closing costs we just talked about, minus any earnest money deposit you've already paid. If this number is significantly higher than you were expecting, or if you don't understand where it came from, you need to call your loan officer immediately. Do not wait. The 3-day window is designed for you to ask these questions and get them resolved before you're under pressure with a pen in your hand. Okay, you've reviewed your closing disclosure. The numbers make sense. You've arranged for the funds, typically via a certified cashier's check or a wire transfer. A quick but critical warning on wire transfers. Wire fraud is rampant in real estate. Scammers will send you fake emails with phony wiring instructions. Always verbally confirm the wiring instructions with your closing company or attorney using a phone number you know is legitimate, not one from an email. Never trust wiring instructions sent over email alone. Now it's closing day. You'll go to the office of the title company, escrow agent, or attorney. You might be there with your real estate agent, the closing agent, and sometimes the sellers, though it's common for sellers to sign at a different time. In front of you will be a stack of documents that looks like a small novel. Don't be intimidated. The closing agent's job is to walk you through it. You're not signing 100 different things. You're signing a few key documents multiple times. The two giants are the promissory note and the mortgage or deed of trust. The promissory note is your IOU. It's the legal document where you promise to repay the loan, detailing the amount, the interest rate, and the terms. The mortgage or deed of trust is the document that secures the loan. It's what gives the lender the right to take the property back through foreclosure if you fail to pay. You'll also sign documents acknowledging the closing disclosure, tax forms, and other standard disclosures. Take your time. Ask questions if a document doesn't make sense. This is your moment. After you've signed everything, you'll hand over your check or confirm your wire has been received. The closing agent will do their final checks, the funds will be dispersed to the seller, and then it happens. The agent slides a set of keys across the table. They're yours. That's it. After all the searching, the saving, the paperwork, the waiting, the stress, you are a homeowner. In that moment, the entire journey clicks into place. We've covered a tremendous amount of ground together. We started with the dream of a home and broke it down into real manageable steps. We talked about your credit score and debt-to-income ratio, the foundation of your financial house. We navigated the alphabet soup of loans, conventional, FHA via USDA, to find the one that fits your life. We walked through the power of a pre-approval, the thrill of the house hunt, and the nerve-wracking process of underwriting. And now we've crossed the finish line at the closing table. This process can seem complex, even overwhelming from the outside. But it's not magic. It's a series of steps. And now you understand those steps. You have the vocabulary. You know the key players. You know what questions to ask and what pitfalls to avoid. Buying a home is the biggest financial decision most people will ever make. But it's so much more than that. It's not just about mortgages and interest rates. It's about putting down roots. It's about creating a space that is uniquely yours. It's a backdrop for your life's biggest moments and a sanctuary for the quiet ones. It's a testament to your hard work and your belief in the future. The path isn't always easy, but it is absolutely achievable. Don't let fear or a lack of knowledge hold you back. Take this information, use it as your guide, and take that first step. Whether you're ready to call a lender tomorrow or in 2 years, you now have the power to walk into this process with confidence. You can do this. You've got this. Welcome home.